Welcome to How a Business is Taxed. In this video, I'll be going over an overview of the tax types of businesses and how to know which one a business should use. So first, let's start with the 5 business tax types and what their tax return is. Number 1 is the self-employed business return, which is a Schedule C and is submitted to the IRS attached to the personal owner's Form 1040. The Form 1040 is the personal tax return. Number 2 is a partnership business tax return, and that is filed on Form 1065. Attached to the Form 1065 are what's called Schedule K1s for each partner. The partnership does not pay taxes and the activity flows through to the Schedule K1s. The owners then use their Schedule K1 on their own tax return, Form 1040. Number 3 is the corporation, and that files a Form 1120. The corporation files various forms for its owners and workers. Anyone who works in a corporation, even if they're an owner, are taxed as an employee, and so therefore they'll have a W-2, just like anyone who has a job. Number 3 is the S corporation, and this business type is reported on Form 1120S. And it combines aspects of the corporation and the partnership. An S corporation does have Schedule K1s attached to the Form 1120S, just like a partnership, and each member or partner receives their K1, which they enter on their personal return. The 5th type is a nonprofit business, and they use Form 990. If they are required to file. Many organizations that are religious are not even required to file, but others are, and they use Form 990. Okay, so that's the 5 business tax types. So how does a business know which form it should use for its business, and what type of choice do they have to decide between these business types? First, to explain this, the tax type is based on the legal type of business. So said another way, every business has 2 types, a legal type and the tax type. And the tax type is determined by the legal type. Next, we'll look at the 7 most common legal business situations, which includes legal types as well as just common scenarios, and how each one is taxed at the IRS, and any options that they may have to choose to be taxed differently. First, I want to explain why we have these legal types of businesses and how a business goes about becoming a legal type of business. Legal business types and processes give people assurance to spend money because they know that if something goes wrong, that business is going to be held accountable. Legal business types are formed with state law. So not federal law, not the US, but individual states. And every business is required to register in that state, because that makes who owns the business public. And so that if something goes wrong when someone purchases from a business, that information is out there. And you can even go to a state website and look up businesses' names to make sure that they're in good standing. A business in good standing will file every year, and that basically gives your contact information. And every business is required to be able to receive correspondence. The general rule for forming a legal business is that you file some sort of paperwork with the state. Now, every business has to register with the state, but then if you want to form another type of business, specifically, which we'll be talking about, you would file paperwork with the state and follow whatever rules that state has. Creating a legal business with a state, filing that paperwork is not the only thing that the business has to do. They have to actually be separate. And for a business to be separate, they need to keep separate books and records, and they need to not spend personal expenses from the business, pay business expenses from personal. They need things to actually be separate. So the main reason for forming a legal type of business is to give the owners limited liability to protect their assets and even their future earnings from having to pay someone if something goes wrong. So in high sue industries such as the medical industry, people may not be willing to create a business and to work in the business because they would be worried about losing what they have. So you can see how legal business types encourage business owners to create businesses, and they also encourage customers and people who work for businesses to be active as well, to buy, to invest, to work for people, because everyone knows that everyone is held responsible. Okay, so that covers why we have these legal businesses and also how to form them. Okay, so these 7 types of legal business types or situations, and the way that they are taxed or can choose to be taxed from those 5 business tax types. Number 1 is the sole proprietor. Now, a sole proprietor is formed when someone just starts working. If they accept money for products or services that they're selling, then they have created a sole proprietor. They are a sole proprietor. No specific form needs to be filed to form a sole proprietor. They may need to register with the state, as every business does, and follow that state's rules, but there's no specific form to form a sole proprietor. Unlike all of the other types of businesses, a sole proprietor type of business is not separate from the owner. Instead, they are one and the same. It's not separate. When it comes to taxes, our sole proprietor is taxed as a self-employed taxpayer on Schedule C attached to the owner's individual return. So you may have heard the terms sole proprietor and self-employed used interchangeably, but actually sole proprietor is the legal business type and self-employed is the tax business type. A sole proprietor must be taxed as self-employed. That's their only option, and that's the way it works, and that's much in their favor. Now, on the other hand, there's no limited liability here. The business and the owner are one and the same. Number 2, the second type of legal type of business or situation is the partnership. Now, a partnership is formed legally when 2 or more people work together with the intention to share in profits and losses. This means it doesn't even have to be in writing. They could just start. Now, there are other types of partnerships that can be formed with state law, like the LLP. Whether or not they have limited liability will depend on the details of that state and if they form another type of partnership and what their verbal agreement is. It gets very complicated. Also know that most people don't really use the partnership anymore. I'll tell you what they do use in a moment. For tax purposes, the partnership is taxed as a partnership using Form 1065 and giving each partner a Schedule K-1 to report with their personal income tax return Form 1040. The business must file before the partners can file their personal returns. Number 3 is a legal situation, and it's when you have 2 people working together but they're married. As I just explained, they would be required to file this partnership tax return before doing their personal, and the IRS felt like that was cumbersome and a requirement that they didn't want to put on to married couples. And so they created the qualified joint venture, which is an election that married couples can make. And instead of filing a 1065 partnership return, they can split their business activity and report 2 Schedule C's attached to their individual return. So they're essentially choosing to both be taxed as self-employed instead of a partnership business. They make this election by filing accordingly. Now note, to qualify for this election, they cannot have formed any other type of business with a state. Registering with the state is good, that's fine, but they can't have formed paperwork to form a specific other type of business. Number 4 is the corporation. The corporation is a very old legal structure, hundreds of years old. And of course, for taxes, the corporation is taxed as a corporation on Form 1120. Numbers 5 and 6 are the limited liability company, otherwise known as the LLC. Now, because people were forming corporations and they weren't holding up in court because they didn't actually keep the business separate, the LLC was created by states and really took off across the US in all states in the past 20-30 years. And the LLC provides that limited liability protection for the owners, but it doesn't require so many moving parts like the corporation. It's meant for smaller businesses. Now, how an LLC is taxed, you may have noticed there's no LLC tax return like a few of the other types of businesses. And that again was to keep things simple. Instead, how the LLC is taxed depends on how many owners, which are called members in an LLC, how many there are in the business. So number 5 is a single member LLC. And the default for that legal type of business is to be taxed as self-employed, with a Schedule C attached to the owner's individual return, just like the sole proprietor and the qualified joint venture for married couples. This is specifically the best of both worlds, this single member LLC, especially for small businesses who want to form a separate business entity, have limited liability, while also not having to file an actual separate tax return. They get the separate business, the limited liability, they have to maintain separate records. But when it comes to taxes, they're able to be self-employed and still take a lot of those self-employed tax write-offs that they will lose in another type of business, or things just become more complicated and more expensive. Number 6 is the multi-member LLC, which means there's 2 or more members. And guess what the multi-member LLC defaults to be taxed as? A partnership. Tax return form 1065, which then gives the members their Schedule K1s to report on their individual return. If you remember, I said before the partnership is becoming less common, and partly that's because usually people will do a multi-member LLC instead, which gives them that limited liability for sure and in better ways. Lastly, number 7 is the nonprofit, which is a legal business type structured similarly to a corporation, but there's no shareholders and instead there's donors who donate money. And of course, the nonprofit is taxed as a nonprofit. Now, you may have noticed that we have covered all 7 business types and situations, but we did not talk about the S corporation. That's because the S corporation does not apply to any business directly and instead can be elected. Any LLC, single member or multi-member, a partnership, or a corporation can elect S Corp status. However, there are more rules to qualify to form the S Corp. If they meet those criteria, then they can elect to be taxed as an S Corp. In general, an S Corp is for smaller businesses and it can save some tax dollars, but it doesn't save tax dollars for a self-employed business where the owner works in the business. If the owner doesn't work in the business or the business is really growing, they have employees, it's doing very well, it's doing better than an average business of that size, it has extra money, it's paying compensation packages to attract talent to work for them, meaning retirement plans, dependent care plans, paying for college. If it is providing a lot of compensation packages, in those situations, it can save tax dollars. However, with the latest development in business taxes, this 20% deduction, although not permanent, for the next 5 years, I definitely would not recommend forming the S Corp unless you know you accounted for this deduction and that it will save money. So to recap, we covered the 5 business tax types, which of course are self-employed on a Schedule C, partnership on Form 1065, corporation on Form 1120, S Corporation on Form 1120S, and nonprofit on 990. So we've covered these 7 legal businesses and common situations and how each of those is taxed or can elect to be taxed. That's all for this video. Thanks for watching. I'd love to hear from you in the comments below if you have any questions, or if you have a business, what type of business your business is, or anything you've heard about different types of businesses and their tax benefits. Otherwise, if you're new to this channel, you can subscribe to be notified of my next videos, and I'll see you next time. Bye.